At Capella University, you'll get support from people who care about your success. From before you enroll to after you graduate, pursue your goals knowing help is available when you need it. Imagine your future differently at capella.edu.
You're listening to a Mint podcast brought to you by HT Smartcast.
Hello, listeners. Welcome to the latest episode of Why Not Mint Money. I'm your host, Jash Kriplani. Today, we'll be quizzing a fund manager on how he manages his own personal investments. Rajeev Thakkar, who is one of the most well-known fund managers in India, oversees around rupees 60,000 crore worth of investor assets as CIO of PPFAS Mutual Fund. Today, we are in conversation with Rajeev Thakkar.
Welcome to Why Not Mint Money, a personal finance podcast where we help you understand basic money concepts and share strategies for you to build your wealth. So let's get started with your money journey.
Hi Rajeev, welcome to the latest episode of Why Not Mint Money. It's really great to have you here. Rajeev, coming straight to the point, we wanted to connect with you to figure out how your own investment portfolio is doing right now. So can you take us through that? What's your current asset allocation and how it has changed over the last 12 months or a year?
Okay, so not much changes in terms of how the asset allocation has moved. So equity returns, as we all know, are lumpy. They don't come in a straight line. So last year when we were talking, we mentioned that trailing 12-month returns were around 1 or 2%. So the previous year was not that great. In contrast, the current last 12-month period has been exceedingly strong. So last 1 year, equity returns would be 43, 44%, that kind. But largely, I continue to have equity heavy asset allocation. Most of the fixed income allocation that I have comes via the provident fund that I regularly save and the company contributes. NPS also has a big portion of fixed income securities, and gratuity obviously is something that you get lump sum and which largely goes with the number of years of service. So all of these are low risk investments in our portfolio. Apart from this, I have certain allocation to short term debt instruments, which is arbitrage funds, a little bit of bank FDs largely. So this is emergency money plus some extra liquidity. Apart from that, everything is equity. Gold is largely in the form of physical gold, in the form of jewelry, which one tends to inherit in Indian families, gets passed on generation to generation, or purchases are made around the time of weddings and things like that. So largely what it was last year, around 1% in gold, around 3-4% in fixed income securities. So this would account for maybe 5%, and 95% would be in equities. So of course, there is a personal home that one has, that is the real estate that I have, but that is not really from an investing standpoint. It's not to generate a return. It's for primary residence purpose. So that is the allocation modes.
So equity is 95, about 4% you are saying is debt, and about 1% gold, right?
Yes.
So in terms of portfolio returns, it's about 40% over the last 1 odd year.
That is the equity portion.
Yeah.
The fixed income obviously would have around 7%.
Right. And so yeah, in terms of your exposure to PPFAS mutual fund schemes, what split is there in terms of your investments?
Bulk of it is in FlexiCap fund. So very small amounts would be there in the other schemes, which is the saver fund or liquid fund, conservative, hybrid, arbitrage. So those are newer schemes and also smaller schemes. Right. So all my legacy investments are in FlexiCap fund. Right. Incrementally, as per the SEBI circular, the 20% mandatory investment that is there gets split across all these schemes. But given that the other schemes are newer, very small amount is.
Right. So is it similar to, say, 66 would be unlisted share of PPFAS, MF? 33?
Broadly, yes. Yeah, broadly that would be the thing. But given that the unlisted shares don't have liquidity and are not frequently revalued or valued in that sense,
Right.
That is more like a illiquid business asset. Yeah,
Right.
but more or less it would be the
More or
same.
less one third, two third, and 1% remaining in other schemes. And incrementally, did you change your allocation in any way, or did it continue in FlexiCap as such? Because now you guys have a few more schemes than you had in past.
So there's not much change in the overall strategy. The
Right.
only small tweak happened on the fixed income side. So I have moved away from liquid funds towards arbitrage schemes.
Okay.
But other than that, there's not much of change.
Okay. And that I assume for better tax efficiency.
Yes, that is good.
And in terms of your international exposure, how would that be across your
So
portfolio?
I don't have any direct overseas stocks in my portfolio. I don't hold any listed companies as such. The FlexiCap has around 15% of its funds in overseas stocks. So that's really the overseas
Okay.
exposure.
And also in terms of split across the market caps, mid cap, small cap, large cap, how is your portfolio structured around the market cap?
Yeah, so currently small and mid caps would be smaller given that that segment has been a bit expensive for a while now. So it's more towards larger cap, but we do have maybe around 12 to 15%. I would think around 15% in small plus mid caps.
Okay. So I think what you're sharing is the split of your FlexiCap investment, right?
Yes, that's
Right. And the remaining minus 15% is in large cap, largely.
In FlexiCap there would be international and there would be some cash holdings as well, and balance would be the large caps.
Okay. Right. And interestingly, we were at in a different conversation. We're talking about you were finding REITs a bit interesting. Have you been able to increase your allocation there, and how do you look at it now?
Sure. So what has happened just in the last 2-3 years is that interest rates have moved up very, very sharply, even at the short end, whereas yields on REITs have not increased to that extent. So while a REIT is a very, very interesting asset class where you have regular cash flow plus possibility of rent escalations over time, increasing your cash flow and some amount of capital appreciation potential, the sign-ups for the REITs in terms of new customers or letting out more area, that has been a bit slow in the post-COVID environment. The return to office is there, but not at a very accelerated pace. So given the steep increase in short-term interest rates, there has not been much increase in allocation towards REITs, but the space continues to look promising and we will track it closely.
And also, I think you had at some point reduced your emergency corpus significantly, in the sense, not significantly, but halved it from 2 year to 1 year for buying unlisted shares. Where is it now? Have you increased it, or it remains 1 year and you're comfortable with that?
It's back to roughly 2 years of expenses. Incremental savings in the short term fixed income securities have taken the emergency corpus back up.
Right. So, Rajiv, what strategy worked for you last year? Of course, like you're saying and sharing with us that, you have a concentrated exposure to PPFAS schemes, especially FlexiCap. So, and, like you're saying, the returns, bulk of your 40% returns, were largely contributed, I assume, from that fund. But what strategy per se worked for you in terms of that, of FlexiCap fund?
Sure. So one is sticking to the strategy for long term. So if one were to try to get in and get out or frequently rebalance the portfolio, then there would be leakages and one would not be able to participate in the compounding journey. So given that the previous 12-month returns were weak, sticking to the allocation and being equity heavy has helped me in the long run. And last year was a significantly above average return kind of a year. So that worked out well. So what people do is, if they don't need cash flow in the near to mid term, they unnecessarily keep too much of idle money either in bank FDs or in liquid funds and things like that. That tends to bring down the overall returns. Of course, one has to be mindful of the individual goals and risk appetite and things like that. But for people uh, who have longer horizons, being equity heavy works. In my case, specifically, my age now is 51. So I still have, let's say, 9 years before I turn 60 or whatever. So it's not that I need any cash flow in the immediate future, and that allows me to.
And any strategy that didn't, I mean, it's very difficult to point out something that didn't work in a year like past year, but anything you thought, could have been better or probably not. Probably not. I mean, just putting a question out there.
Yeah, so nothing that I could have done about in a meaningful manner, but the restriction on overseas investments has been a bit of a dampener. So after a subdued 2022, some of the overseas stocks were at extremely attractive valuations, which funds in general could not avail of those opportunities. So, of course, one could argue that one can avail of the LRS limit and invest abroad, but even that comes with the 20% tax collection at source, and the tax regime on international funds has become very, very adverse, where there is no long-term capital gains benefit or no indexation benefit. So, yeah, some flexibility on overseas investments would have helped.
And I remember, Rajiv, last year itself, around April, you had talked about small and mid cap looking expensive, and it seems that's the concern on the street right now. How do you see how should investors be looking at markets right now? What do you see for them? Any thoughts that that can help investors who are listening into our conversation?
So if we were to look at the market structure, the way things are defined, top 100 companies are defined as large caps. Next 150 companies are the mid caps. And beyond that, it's the small cap space. So typically, the top 100 companies in India account for 75% of the overall corporate profits. So given that kind of market structure, and next 150 companies would probably account for another 15% or so. So given this kind of a structure, it's fascinating that people go so overweight in the small cap space, thinking that some thing wonderful will work out, or a small cap company today will turn out to be a large cap tomorrow. Now this happens on rare occasions, but that is not the usual case, and most small caps tend to remain small caps, and most mid caps tend to remain mid caps. So to that extent, I would recommend some bit of caution. It is better to be contra-cyclical here. So small caps get sold down very badly in down markets. That's the time to actually increase weight to small caps. And in markets which have had significantly positive returns in the recent past, the small and mid caps tend to be a bit expensive. So one needs to calibrate investments in that sense.
So a good time to invest in say mid or small caps, or probably going down the market cap curve, is when they fall. And I mean, being a bit sadist, but significantly fall, which makes it attractive, and that's a good time to get into them. Right. And Rajiv, another thing we discussed, and we have been talking on sidelines at conferences also, on the lighter side, as you are growing older, you are also working towards losing weight, and so what's the status there? How are you keeping yourself fit and healthy? Because healthy body, healthy mind, and healthy investing all go in hand.
So weight is more or less under control, so it's close to the ideal weight that should be there.
To historical averages?
So I would have lost a little bit in the past 12 months, maybe a kilo or two, and that is not so much of a challenge. Weight and waistline both have been reasonably under control. Food continues to be good in terms of good food habits. Exercise last year as well, I mentioned, and this year, same thing continues. I could do with a little bit more. So I could be moving a bit more and probably taking up a sport or going to the gym more. So that is again work in progress.
But you are finding now gym interesting. I think you are looking at alternates.
So gym is something that I need to do. It's not that something I enjoy doing.
Okay, it's a part and parcel. I mean, it's like you have to do your fundamental analysis, so you have to get that right. Okay, and yeah, I guess more or less, I think we are covered. So thanks a lot, Rajeev, for joining us today and taking us through your portfolio. And it's really interesting to get into the portfolio of a fund manager like you. Thank you so much. Thank you, listeners, for joining us today. If you liked this episode and would like to hear to more such interesting conversations, do log into our channel Why Not Mint Money on Spotify, where you'd always find me omnipresent. Also, if you have any new ideas or suggestions, you can DM me on Twitter. My Twitter handle is @Jash Kriplani, that is JASHKRIPLANI. You can always reach out to us over the email. Our email ID is mintmoney@livemint.com.
To stay updated on this podcast, follow us at HT Smartcast on all the major social media platforms. To listen to more such podcasts, log on to www.htsmartcast.com.
At Capella University, you'll get support from people who care about your success. From before you enroll to after you graduate, pursue your goals knowing help is available when you need it. Imagine your future differently at capella.edu.